Bundacho Limited. The management of Bundacho Limited is in the process of evaluating two projects, namely Alpha and Beta. The estimated pre-tax cash flows of each of the projects are as shown below. So we have years 1 to 6. We have Project Alpha, pre-tax cash flows, Project Beta, pre-tax cash flows. So we have there Project Alpha costs 3.8 million and has an estimated lifespan of 4 years. Project Beta costs 8 million with an estimated lifespan of 6 years. Both projects have a zero salvage value. Note 4, an investment in working capital of $825,000 will be required, irrespective of the project to be undertaken. Note 5, the cost of capital for the project is 12%. The corporation tax rate is 30%. Using discounted payback period, recommend to the management of Bundacho Limited on which project to do what year to undertake, which project to undertake. Ladies and gentlemen, the first thing that will draw my attention to how I should tackle this question is note number 6. Note number 6 is giving us the corporation tax rate. Whenever you are given corporation tax rate, in these questions of discounting, in these questions of present valuation, net present value, etc., payback period, discounted, etc. models, whenever you are given corporate tax, one thing always stands out clearly for us, which is computation of depreciation. So we are writing there that because the rate of taxation has been given, we shall compute depreciation of the projects. We shall compute depreciation of the project. So let us go ahead and compute the depreciation ourselves very first. Let's go ahead and compute depreciation ourselves very fast. I'm emphasizing the point that if tax rate wasn't provided, then depreciation would have been irrelevant. But because here note number 6 is giving us the rate of taxation, then ladies and gentlemen, depreciation here becomes what here? Relevant. Depreciation here becomes relevant, and we shall have to compute these. So go to Project Alpha. So depreciation, Project Alpha. So Project Alpha depreciation, ladies and gentlemen, Project Alpha depreciation, they have told me to use straight line. They've told me to use straight line method. And of course, if they are quiet, we always prefer straight line method to any other method in finance. So we shall use straight line method where you will come and give us the depreciation per annum, which will be equal to the initial cost minus the scrap value all over n, number of years. Initial cost minus scrap value all over number of years, So please come and give us the initial cost of Project Alpha. They have told us in note number 1, Project Alpha costs 3.8. So let's use shillings thousands just to be consistent with what is given up there. So in terms of shillings thousands, this will be 3,800 minus the scrap value as per note number 3. Both projects have a zero salvage value. So scrap value should be 0 divided by n, where n, they've told us in note 1, the project's lifespan, project A's lifespan is 4 years. So 3,800 divided by 4. 3,800 divided by 4. So we have here 3,800 divided by 4, giving us 950. From there, right away, come and give us depreciation project Beta. Depreciation project Beta, ladies and gentlemen, we have the initial cost of the project. Initial cost of the project Beta is 8,000. 8,000 minus scrap, which is 0, divided by the useful life of project Beta, given in note number 2. Useful life of project beta is given in note number 2, which is what they are 6. So we have 8,000 divided by 6, which at the end of the day gives us 33.333 if we are correct. Now, ladies and gentlemen, look at the question required using discounted payback period method. So the key thing there is discounted. And remember, we do not discount profit. We normally discount, ladies and gentlemen, we normally discount cash flows. So you can see there they have given us the project alpha pre-tax cash flows. Project alpha pre-tax cash flows. Project alpha pre-tax cash flows. So these pre-tax cash flows, I would want you to listen to me very well. The pre-tax cash flows are basically, ladies and gentlemen, profit here before depreciation and what here? Tax. Profit before depreciation and taxation. Right? Any problem there? Or which question? Perhaps I've moved quite fast. We are looking at, ladies and gentlemen, November 2018, question number 2B. November 2018, question number 2B. How many students have that question with them? I can see so many of them. I can see so many of them asking questions. Could you kindly send them that sitting on WhatsApp? Just send them there. You can get it very fast. Or if anybody has got that question, simply pick it very fast and then you send it to our WhatsApp. But if you remember again, I'd given you the questions which were to do. You guys were to print them. I gave them on your WhatsApp because this wastes some time. Now, do we have the question, all of us? Hello, are you able, do you have the question now? They can't. Yeah, Mohammed has shared all the past papers of FM, so we expect everyone to download them so that we can do what? We expect everyone to download them and print them. Great. They are thanking you, Mohammed, for that good job that you've done. So you don't waste time next time. Now, as we wait for students, ladies and gentlemen, to really come up to speed with this question, I would want us to do something a little bit different. A little bit different. Because I can see they are talking of payback period, and perhaps some of us may not be knowing what payback period is. Now, if, for example, you are given a situation, you are given cash flows here. This examiner gives you cash flows year 1, year 2, year 3. And then he gives you year 1 cash flow to be 10, year 2 cash flow 15, year 3's cash flow, he gives you, for example, 4. And then he tells you that the initial outlay is 18. Is Kenya shillings 18. And then you are required, ladies and gentlemen, you are required here to determine the payback period, the normal payback period. The normal payback period, perhaps at the back of your books, if you could copy this very fast, I just show you how to get the payback period normally before we look at the discounted payback period at the back of your books. At the back of your books. So step number 1, if you're to get this kind of a question where the examiner tells you to determine the payback period, the first thing you need to know, ladies and gentlemen, is the meaning of the word payback. Today I'm investing 18, perhaps 18 million. I would want to know this project that I'm putting this money to, how long will it take that project to give me back my money? The payback period. So the very easiest thing that you need to do, ladies and gentlemen, if you are given this kind of cash flows, is for you to come and give us the cumulative probabilities. So cumulative probabilities, you're accumulating these figures, or rather cumulative cash flows, cumulative cash flows. So come and accumulate the cash flows downwards. So accumulating the cash flows downwards, what do we have? We have 10. Add these here, that gives us what, somewhere there? 25. Come and add this 4 here, which will give me a total accumulated cash flow of what here? 29. And then now I want to look at how long will it take us to recover the initial outlay of 18. You can see on the very first year, I'll be able to recover 10. On the second year, I'll be able to recover, but you see, I want exactly 18. So 18 is in between here. 18 is in between 10 and 25. 18 is in between 10 and 25. We're writing this at the back of our book so that you can bring everyone up to speed as regards to what you're doing today, what you shall be doing today. Now, it means, ladies and gentlemen, that my payback period falls in between, falls in between years 1 and years what year? Years 2. Falls in between years 1 and years 2. It falls in between years 1 and years 2. But you see, the examiner would want you to ascertain the exact payback period. He doesn't want a range. So the exact payback period, you use what we call the interpolation. You use what we call the interpolation. Is there any student here who is able to interpolate for us? Is there any student who can interpolate this for us? So we want to come and interpolate, ladies and gentlemen. To interpolate is quite a simple thing. What I'll need to do is to come and say here, my exact payback period equals, we've said it's in between 1 and 2, so I start with the lower period, which is 1, plus, ladies and gentlemen, between these two, of course, we have got exactly what year? Somebody, 1 year. So between these two, the difference there, 2 minus 1 gives me 1 year. This 1 year is the one that is to be apportioned. The 1 year is the one that is to be apportioned. So how do we apportion this? We'll come and use this side here to make our apportionment. So the apportionment, we have got 2 arcs. We have what we call the upper arc and this big arc. So we'll come and say 1 plus 1 times the upper arc difference. The upper arc difference will be 18 minus 10. 18 minus 10 gives me 8. All over the big arc difference. Big arc difference, we have 25 minus 10, giving us what figure? Somebody there? 15. So that concept of upper arc and the lower arc is very, very important. So ladies and gentlemen, if that is the case, could you kindly interpolate this? Could you kindly give us an interpolation there plus the lower duration straight away? So using your calculator, what parameters do we have here? So we have here 1 plus 1 times 8 divided by 15, which at the end of the day will give us 1.533. 1.533. So 1.533 years is the exact duration it will take us, ladies and gentlemen, for us to be able to recoup our initial investment. Thank you very much. Now, but you see, your examiner nowadays cannot put it to you that easily. Your examiner nowadays, he'll go ahead in the additional information and give you the cost of capital. He'll give you the cost of capital. Your examiner will come and give you the cost of capital. He'll give you the cost of capital is 10%, for instance. And then you'll be required, my great friends, to determine the payback period. What we call the discounted. You determine the discounted payback period. You determine the discounted payback period. So then how do we get this discounted payback period? Ladies and gentlemen, for us to be able to get this discounted payback period, this will be quite a simple thing to do. What you need to do is to come and give us the discounting factors. You discount the cash flows. Any question? Discount the cash flows. So come here and give us the discounting factors. These discounting factors, basically, they will be our PVIF. PVIF is present value interest factor. And if you can recall, why are we making use of PVIF here? We are making use of PVIF simply because our cash flows are doing what? They are fluctuating. So the PVIF here formula, which I've just shown you when we started, is 1 plus R raised to negative what here? Negative N. Of course, ladies and gentlemen, If we have, like now, we know 10% is found on our tables there. If you go to the discounting tables, 10% is there. You are better off reading that particular table about, in this case, you're rather on the 10%. Simply go to the 10% and then you walk through the periods like that. But normally what I tell my students, I normally prefer, ladies and gentlemen, students who are able to use the formula throughout. Because in most cases, they'll give you a discounting cost of capital, which is not within the table, like 9.2, etc., etc. So we are better off always knowing how to discount this using a calculator. So then our R is the cost of capital, which is 10%. So then this will be 1.1 raised to, the first period here is 1. So we have there 1.1 raised to -1, which will give us what figure, somebody here? 0.9091. The same raised to -2, which will give me 0.8264 raised to power 3. Raised to power 3, which will give me 0.7513. And then you come and create a column of discounted cash flows, where you discount now your cash flows. So discounted cash flows. Discounted cash flows are also known as what here? Present values. Present values. So please come and multiply, like now this and this will give me 9.091. And then we have 25 and that. So we have here 25 times 0.8264, giving me 20.66. And then lastly, we have 29 times 0.7513, giving me 21.79. Now from there, ladies and gentlemen, come and give us the total 21.79 plus 20.66 plus 9.091, which in this case I'm getting as 51.541. This one here will be called the total present value. If I'm in need of the net present value, if I am in need of the net present value, what I need to do is to come and subtract the initial outlay out of this. Out of 51.541, you deduct what here? 18. You deduct the initial outlay for you to get NPV. I had to go up to that because I can see I've got some 2 new students here, and NPV is quite good. But you remember, in this question, they don't want us to get the net present value. In this question, they wanted us to find a payback period, but now this time around, using the discounted what here? Cash flows. Using the discounted cash flows. So these are our discounted cash flows. These are our discounted cash flows. Those are our discounted cash flows. And once I have my discounted cash flows and I'm in need of getting the payback period, what I need to do is to come and give them the cumulative. You, my cameraman, can see me up to here. Give us this cumulative discounted cash flows. The cumulative discounted cash flows, we are accumulating these cash flows downwards. We are accumulating these cash flows downwards. So what do we have here? Somebody, 9.091. Come and add the 9.091 to this figure. You add. Somebody add for me and then give me the cumulative cash flow for this. 9.091 plus 20.66. What do we have? 9.091 plus 20.66. What do we have there? Somebody. What do we have there? I'm waiting to hear. 29 point. Thank you very much. And then lastly, we have this 29.75 plus 21.79. 29.75 plus 21.79. What figures do we have there, somebody? Mm-hmm. 51.54. Thank you very much. Now, ladies and gentlemen, remember, for me, what I'm interested in is to know how long will it take me to recover the initial outlay? Don't forget, initial outlay amount is never discounted, because this is an amount which is being incurred today. So how long will it take me to get this 18? So come and fit this 18 in this cumulative cash flows. So you fit 18 here, fit 18 there. And then from there, ladies and gentlemen, please go ahead and give us the payback period now. The payback period. Just try. Today, you guys, I don't want to talk to me so much. I'm used to this class being a talkative class. I don't know about this class in any other way. I know that they are very aggressive. So I want somebody to come and discount, or not discount, but give us the exact payback period. Give us the exact payback period. So remember, our payback period, you're going to see where 18 is. It falls in between, again, what year? Year 1 and year 2. So it means that the exact payback period will be equal to the lower duration plus the difference between the two. 2 minus 1. 2 minus 1 gives us what there? Gives us 1. Times the difference of the upper arc. The upper arc is here. The upper arc from 18 to 9.091. That difference is what you give us. So we have 18 minus 9.091, which gives us 8.909. Come and divide this by the base arc, the bigger arc, the base arc. The base arc, I'll take the difference between those two numbers, 29.75 minus 9.091, which gives me 20.659. Now, could you kindly then give me the exact payback kindly? What will we get at the end of the day? So we have there 1 plus 1 times 8.909 divided by 20.659, which will end up giving us 1.431, like that. 1.431. Yes. Is there anybody who has that kind of an answer there? Phoebe, thank you very much. Yes. Now, please, let's now get back to this November. I hope now all of us have the past papers, and please print them. If you don't print them, we start looking for them all over during class time. That will always lead to wastage of approximately 10 minutes. 10 minutes. So, November 2018, question number 2B. The management of Bundacho Limited is in the process of evaluating 2 projects, namely Alpha and Beta. Then they have given us the estimated pre-tax cash flows of each of the projects are as shown below. So they've given us from year 1 all the way to year what year? Year 6. Year 1 all the way up to year 6. So I'll come and copy. I'll come and first of all compute the discounted payback period for project Alpha. So mention there project Alpha. It's even good we started doing this question from scratch. Would have really messed. There's something here that would have taken us to hell. So we have here cash flows, discounted cash flows of Alpha, project Alpha. So we have here our year. So we have here 1, 2, 3, 4, 5, 6. Yes. And then they have given me what they are calling the pre-tax cash flows. Pre-tax cash flows. So pre-tax cash flows, what do we have there? Somebody 2590. The second one is 2880. The third one is 3050. The fourth one happens to be 29 what year? 50, and then there's nothing there, nothing there. Now, ladies and gentlemen, whenever you are given a pre-tax cash flow, your life becomes very easy. Whenever you are given a pre-tax cash flow, what you're supposed to come and give us is the after-taxation cash flow. After-tax cash flow. After-tax cash flow. After-tax cash flow. How do I get this after-tax cash flow? To get the after-tax cash flow, there are no major adjustments you should ever do. To get the after-tax cash flow, you should always take the pre-tax cash flow, multiplied by 1 minus taxation. You simply tax these because they're called these figures cash flows already. So even the division we are computing last time is not neither here nor there. Because already these are what here? Cash flows. They're already cash flows. Only that they have not looked at the tax effects. Now that we have the pre-tax cash flows here, what I would want us to do is to come and give them the after-tax cash flows. After-tax cash flows, supposed to be after-tax cash flows equals pre-tax times 1 minus t. And the taxation rate has been given as 30%. Look at note number 6. Note number 6, the corporate tax is 30%. So it means that my 1 minus t will be 1 minus 0.3, which gives me what here? 0.7, which gives me 0.7. So what you need to do is to come and multiply these figures consistently with what here? Somebody 0.7, consistently with 0.7, for you to be able to get the after-tax cash flow. For you to be able to get the after-tax cash flow. So you take 2590 times this. Give us a figure. We write. 2590 times 0.7. Give us a figure we write here. So we have here 2590 times 0.7, giving us 18 what here, somebody? 1813. From there we have 2880 times 0.7, giving us 2016. From there we have 3050 times 0.7, giving us 2135. From there we have 2950 times 0.7, giving us 2065, like that. Now, having gotten those pre-tax or other after-tax cash flows, the next thing, because this examiner wants me to ascertain the discounted payback period, I need to come and look at the discounting factors. So mentioned there, discounting factors. These are basically the PVs, which will be 1 plus R raised to negative N. Discounting factors, PV, present value, interest factor, which is 1 plus R raised to negative N. So 1 plus R. Have they given us the cost of capital? Yes. Note number 5. They have told us that the cost of capital of the company is 12%. So then we have here 1 plus 12%, that is 1.12 raised to minus 1. 1.12 raised to minus 2. 1.12 raised to minus 3. 1.12 raised to minus 4. Give us figures. So we have 1.12 raised to minus 1, giving us 0.8929. Then we have 1.12 raised to negative 2, which gives us 0.7972 raised to 3, which will give me 0.7119. And then raised to power 4, what do we have there? 0.6355. Now, once I have my discounting factors, I will move with speed to multiply them with this, so that I can get what we call the discounted cash flows, so that we can get the discounted cash flows. So move with speed and they give us the discounted cash flows. Move with speed for you to give us the discounted cash flows. So we have here discounted cash flows, discounted cash flows, discounted cash flows, discounted cash flows. What do we have here at the end of the day? So discounted cash flows, ladies and gentlemen, will be 18. Please check for me whether there is any question there. We need to move together with this series of mine. 0.8929 equals, we can decide to work with 2 decimal places, no problem. 2 decimal places for the discounted cash flows. PVs, of course, they must be 4. But discounted cash flows, 2 is sufficient. So we have here 18.83. 2016 times 0.7972 equals, we have here 1607.16. We have 2135 times 0.7118, giving us 1519.69. And then we have 2065 times 0.6355, giving us at the end of the day 1312.31. Now, ladies and gentlemen, who can talk to me today? Who can tell me, what do you think do we need to do for us to be able to get the payback period, which is discounted from this information given? What do you think could be the next step for us? What do you think will be the next step for us? What do you think will be the next step for us? Somebody talk to us tonight. What do you think will be the next step for us? Somebody talk to us. No. Depreciation here will not feature at all. Why? Because the examiner gave us what here, somebody? This. If he had given us the way we had thought, profits before depreciation and what, or rather any profit figure, then depreciation would have been relevant. But now here he gave us cash flows for us. The only thing that he never did was the tax adjustment. Now the next thing that you're supposed to do here is to come and ascertain the cumulative. Give us the cumulative, give us the cumulative discounted cash flows. Give us the cumulative discounted cash flows. So you're accumulating them downwards. We start with this, which is 1618.83. So we have here 1618.83 plus 1607.16 equals, I'm getting 25.99 plus 1519.69 equals, I'm getting 45.68 plus 12.31. I'm getting 57.99. Now, ladies and gentlemen, now having gotten those cumulatives, I know that the next thing will be for me to locate, will be for us to locate the initial cost of the project. The initial cost of project Alpha is 3.8. The initial cost of project Alpha is 3.8. Can someone tell me where does 3.8 fall in these cumulative cash flows? The cumulative discounted cash flows, where does 3.8 fall? Tell me, between which year and which year? Tell me. Between which year and which year? 3.8, is there somebody who is able to see? Between years 2 and 3. Between years 2 and 3. Between years 2 and 3 years. So between years 2 and 3 here, we have our 3.8. We want our figures here to be consistent in terms of 3 zeros there. Yeah, 3. So 3.8 is the same as 3,800. 3,800. Now, ladies and gentlemen, you are telling me that this 3.8 falls here between years 2 and 3. So if it is between years 2 and 3, who can go ahead and give us the payback? Who can go ahead and give us the payback period? The payback period. Please go ahead and give us the payback period. Go ahead and give us the payback period. Go ahead and give us the payback. Thank you very much. I can see responses there. Students are really, I should even now move with my normal speed, because I was wondering today what is not happening. Now comes my students don't want to respond. Now see the charts, now I can see we're together. Remember, it doesn't matter, even if you get it wrong when you are responding, getting it wrong is part of studying, it's part of learning, it's part of learning, it's part of learning, it's part of learning.
There's a question.
Yes.
There
is a problem. There's a problem. There is working capital. There is working capital. We are told in note number 4, an investment in working capital of 825 will be required. Thank you very much. So in this case, ladies and gentlemen, the initial outlay changes slightly. The initial outlay, thank you very much for that question. The initial outlay changes slightly. So we have the initial cost of the project. Initial cost of the project is the one that is 3,800. And then of course you'll come and add the working capital, which is required. Sorry for that. Add working capital required of 825 for project A. For project, an investment in working capital of 825 will be required. So 825, thank you very much for that. So please give us this total here. Give us that total 3,800 plus 3,800 plus 3,800 plus 825. Now that you have started speaking now, so this gives us 46 what here 25. So where is 4625? Still 4625 falls here. 4625 falls there. Yes. So still 4625 falls in between. Yes, 2 and 3. So I would want to hear from somebody. What will be our payback period? What will be our payback period? And to see whether there is anybody who will be able to get this very easily. Payback period will be equal to is anybody who has been able to get that payback period? So perhaps I could do this for them. So for the payback period, what I'll do is to come and pick the lower duration, which is 2, plus the difference between the two durations, bigger duration minus smaller duration, multiplied by our pro rata figures. Our pro rata figures, you have to be quite keen here. We have what we would have called in this case here the upper cut or arc. So the upper arc we have here 4625 minus 3225.99 all over the base arc. The base arc, what do we have there? 4745.68 minus 3225.99. So please give me the final answer, but before you reach there, you have to really use body mass. 3 minus 2 gives me 1 there times upper limit. Upper limit, what do we have? Upper limit, we have 4625 minus 3225.99, which gives me 1399.01 all over 4745.68 minus 3225.99, which gives me 19.69. So we have here 1399.01 divided by answer equals times 1 plus 2, which gives me 2.92 years. Is there anyone who got that kind of figure really? 2.92 years. Alex, thank you very much. And then I want to believe that you great students of mine will be able to go to Project Beta and do the same. And then you give us a recommendation. You should be able to go to Project Beta and do the same. And then, of course, you give us a recommendation on which project you deem to be inferior in terms of payback period. Of course, the project that pays you much faster is the one that is recommended. The project that pays us much faster is the one that is recommended. So project beta, I expect you great students of mine to attempt getting the payback period of project B. Now let's get now to a very serious question, and I would want you guys to participate so seriously here now. May 2018, question number 2B, and then we have to move with some little speed so that we can finish this question tonight. So May 2018, question number 2B, do they have that question? May 2018, question number 2B, Kabusa Limited. Kabusa Limited is contemplating the acquisition of a new machine to replace the one that is currently being used in production process. They are telling us that the existing machine was acquired 2 years ago at a cost of 8 million. 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life of 5 years with no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1.5 million. Yeah, sorry for that hiccup. This technology, we are trying to learn the ropes. So we are told here that the existing machine was acquired some 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life of 5 years with no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1.5 million. The existing machine can be disposed of now at shillings 4 million. The new machine is expected to cost 12.56 million with a salvage value of shillings 4 million at the end of its useful life of 5 years. The new machine will also require an additional investment in working capital. Please underline working capital there. You should not forget about it. In working capital of shillings 2.6 million at the start of its useful life, which will, however, be recovered at the end of its useful life. The following information relates to the estimated earnings before depreciation and the tax over the coming 5-year period for the two machines. So we have the new machines vis-a-vis the existing machine. So we are told here, Kabusa Limited's cost of capital is 13%. The company applies straight line method of depreciation. The corporate tax rate is 30%. Using the net present value technique, advise the management of Kabusa Limited on whether to replace the existing machine with the new machine. So this is an examiner who is wishing me success. And remember, this is an area that I have to know because it rarely misses in my exams this concept of replacement of machines. Replacement of machines. Replacement of machines. If you look at your past papers, like if you look at November 2017, if you have your past papers, November 2017, even now they are starting from up there. Current bottling company is considering replacing one of the bottling machines with a more efficient one. The old machine has a current net book value all over. If you look at, for example, even the other one of November 2016, Muarakaya Limited is considering, November 2016, Muarakaya Limited is considering the acquisition of a new machine to replace the existing. So very, very common. And that's why I've chosen this one, which is very comprehensive. Once we appreciate this, then we'll have known everything about this replacement of machines. We did one question in our last class. So where do we get started? Where will we start tackling this question from? We normally look at the three types of cash flows that I told you. Number one, we have cash flow at the beginning, we have cash flow at the end, and then we have got in between the operational cash flows like that. So let us start with the initial cash outlay. Initial cash outlay. Initial cash outlay. Outlay required for replacement. Required for replacement. Required for replacement. How much do we need for replacement? The moment I'm able to tackle this, then I will have known how to tackle every other thing. So the initial outlay required for replacement, of course, I have the cost of the new machine. The cost of the new machine, who is able to give us the cost of the new machine from the question? The cost of the new machine. Cost of the new machine from the question. We want to see whether we are following. The cost of the new machine is required. If we are to replace, we have to buy the new machine. So cost of the new machine, what are they telling me there? Cost of the new machine from paragraph number 2. From paragraph number 2, the cost of the new machine is, paragraph number 2, the cost of the new machine is how much? Somebody. 12.56. In terms of thousands, I'll talk of shillings. 12,560. Thank you very much. Is there any other expense we need really for us to be able to do a replacement? Yes. Once I do a replacement, I acquire this new machine. The new machine can't run itself. We need to come and add. Add, in this case here, the working capital injected at the beginning. What is the working capital, ladies and gentlemen, which we are given there, which we need? We are told that the new machine will also require an additional investment in working capital of 2,600 at the start. At the start. So in this case here, we have working capital 2,600. 2,600. Now, ladies and gentlemen, once I have that, I have to think about something very, very important. Something very, very important, which is on replacement, the old machine is going to give me some money. The old machine will be giving me some money. So this old machine giving me some money, it will be a relief for us. So in this case here, less the scrap value, or rather the cash proceeds. The cash proceeds. The cash proceeds of old machine. The cash proceeds of old machine. The cash proceeds of old machine. What do we have there? Somebody, we are told in paragraph number 1, the last sentence of paragraph number 1, the existing machine can be disposed of now at 4,000. 4,000. So in terms of cost, in terms of what I need at the beginning, this will be a relief on me. So I have to subtract. Then the other component that so many students will forget is the concept of what here? The taxation. The tax on disposal. Disposal. So meaning that you need a disposals account. You need a disposals account. So come and give us a disposals account. Come and give us a disposals account. Give us a disposals account. So disposals account, ladies and gentlemen, what do we have here? Disposals account, what do we have here? Disposals account. I would want to know, this old machine that I'm going to dispose, am I going to make a profit out of it? Or in this case here, am I going to make a loss out of it? So I need the net book value of the old machine. Net book value, old machine. You guys are accountants, could you kindly help me calculate the net book value of the old machine? You guys are accountants. Please give me the net book value of the old machine. Remember, the most important thing for this old machine that I would want to get tonight, it will be the accumulated depreciation. We are told that at the point of us selling this machine, 2 years have lapsed. We bought the machine for 8,000. Don't write on this. This still is an area that I'll need. So the cost of the machine was 8,000. We are told in this case here, the old machine does not have any scrap value. If you read that question very well, we are told that the third line, first paragraph, the third sentence, first paragraph, the existing machine was estimated to have a useful life of 5 years ago with no salvage value. No salvage value. So it doesn't have any salvage value. So divided by what year? 5 years. Divided by 5 years. Divided by 5 years. Could you kindly give me this figure? This is depreciation per annum. Depreciation per annum. Depreciation per annum. 8,000 divided by 5. Somebody tells me it is 1,600. But remember, since the time we bought the machine to the time that we want to sell it, the machine has knocked how many years? 2 years. And therefore, the total depreciation, the total accumulated depreciation will be 1,600 times 2, which gives us 3,200, like that. And therefore, by the time I'm selling this particular machine, its net book value, which is cost minus accumulated depreciation, its net book value will be the initial cost of the machine, which was 8,000 minus 3,200, which will end up giving me what figure? Somebody as our net book value. Net book value. Kindly give us a net book value. Net book value 8,000 minus 200. Kindly help me so we can move with speed. 4,800. So remember, when you sell a machine, what do? You normally go to the property, plant, and equipment. Remove that particular machine from that particular account at net book value. You credit the property, plant, and equipment, or you credit that particular machine's account with the net book value of the machine. And then, of course, you take straight away the figure to the disposals account. So we have the disposals account having like that, 4,800. And then, ladies and gentlemen, now we'll go to the credit side. On the credit side of the disposal account, what do we do? Disposals, we dispose the machine like this, we receive cash, debit this cash in the bank account, and then credit the disposals account with that amount. So the proceeds are normally taken to the credit side of the disposals account. So this disposals account, this old machine, what have they told us? The last sentence of paragraph number 1, that the existing machine can be disposed of now at 4 million. 4 million to us is the same as 4,000. So this is bank. This is bank. Now, ladies and gentlemen, from there we balance the account. I can see the account balancing figure is coming on this side. For us to have 4,800, our balancing figure is coming on this other side. When it comes on this side, is it going to be a loss on disposal or a profit on disposal? Somebody. Loss on disposal or profit on disposal? It's a loss on disposal. Because once it goes here, it means that I credit the disposals account and then I debit the P&L. Debit on P&L, that means it's a loss. If it's crediting the P&L, it becomes what here? A profit. So this is a loss on disposal. A loss on disposal. So what we shall do, ladies and gentlemen, is to come right away here and take 30% of my loss. My loss, which is minus what here? 800. Remember, many times I've proven to you that whenever you even get a loss, it will be important for you to tax. You tax a loss, a negative profit. So 30% of minus 800, it's like the taxman is refunding money for you. The taxman is sympathizing with you. So 30% of negative 800, this will end up giving us what figure at the end of the day, ladies and gentlemen? 30% of negative 800. That gives us negative what here, somebody? Negative 240. So it's an income to the company because we have made a loss. We shall claim a tax relief on that loss from KRA, and that is it. Come and give us the initial outlay. Give us the initial. Whenever they talk of existing machine, old machines, always remember this working. Can even cram it. So we have 12,560 plus 2,600. Those are expenses. These two are our incomes as a result of what disposing the old machine. So in terms of income, so disposing the old machine, we have the sales proceeds, and then we have the tax on this particular loss. It's a negative figure. You can either put it as a negative or you put it as in brackets like that. So what figures do we have here, somebody? Yes. I'm being given a figure of 11,400. 11,400. Is that true? Because I can see there is a 60 and there is a 40 here, so it cannot be really exactly 400. 10, 9, 20. Yeah, because you can see 40 and 60 there. 10, 9, 20. Thank you very much. Now, having gotten this initial outlay, I told you three things. Cash flow at the beginning, cash flow at the end, and then cash flow in between. So we've gotten cash flow at the beginning. Let's get cash flow at the end. So cash flow at the end, we normally call that the terminal benefits. The terminal benefits. So the first terminal benefit is a scrap value. When these projects expire, we will have to get something. Yeah, we'll be selling this as scrap. So this scrap value, always remember, it's supposed to be incremental. You take the scrap of the new machine minus scrap of the old machine. Incremental. You can either decide to subtract or you handle them separately. Incremental. So for scrap, can somebody, ladies and gentlemen, give me the scrap value of the new machine? The new machine. Remember they told us there, ladies and gentlemen, that the new machine is expected to cost how much? 12.56 million with a salvage value of 4 million. Salvage value of 4 million. At the end of its useful life of 5 years. So the salvage value of this machine, new machine, is 4,000 minus the salvage value of the old machine. The salvage value of the old machine. Remember, when we took in this old machine for evaluation, after 2 years, they gave us new, let us read that first paragraph. Let's read the first paragraph very well. We are told Kabusa Limited is contemplating the acquisition of a new machine to replace the one currently being used in production process. The existing machine was acquired 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life of 5 years with no salvage value at first. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1.5. So if we're to leave this old machine to continue with us, we are assured of getting 1,500 as the salvage, as a scrap value for the old machine. And therefore, when I'm looking at the net benefit of the new machine, I'll be looking at the scrap of the new minus what scrap the old machine would have given me if I never replaced it, which is 1,500. So could you kindly give us this figure? Kindly give us that figure. 4,000 minus 1,500 gives us what here? 2,500. Now, ladies and gentlemen, let me ask you a question in terms of benefits other than the scrap value. When these machines have become very old, other than the scrap value, What else do we expect to have here? When you're terminating the project, what else do we expect to have there? When terminating this project, what else do we expect to have there? WC. Who is giving us that answer? Like 4 of them. Thank you very much. So we have here working capital. And then remember that this working capital is capital that is being released to us. Working capital is capital which is being now released to us at the end of the project. So at the end of the project, this working capital being released to us, we are adding it. We are adding it. So also remember, for working capital, we talk of incremental, incremental. Please look for information which is talking of this working capital. It's paragraph number 2, where they have told us the new machine is expected to cost 12.56 million with a salvage value of 4 million at the end of its useful life for 5 years. The new machine will also require an additional increase in working capital. You can see it's already an increase. So the increase, don't subtract there, it's an increase. So we have what there, somebody? 2,600. 2,600. And that will be the total cash flow, which is 5,100. So this is what we call the TC, the terminal cash flow. The terminal cash flow is 5,100. The terminal cash flow is 5,100. Terminal cash flow is 5,100. 5,100. Now, we come to the gist of the question. Want to do now the cream to take over the juicy part of this particular question. Ladies and gentlemen, the operational cash flows. So mention there for us, operational cash flows. The operational cash flows. Operational cash flows. So these operational cash flows, what do we have there? Operational cash flows, ladies and gentlemen, I can see them. Let me just delete this because I know you guys will give me the figures. Operational cash flows, operational cash flows, operational cash flows, operational. Operational cash flows. So under operational cash flows, we have 5 years. They have given us year 1, year 2, year 3, year 4, year 5. Ladies and gentlemen, I'm able to see the profit before depreciation and tax. Profit before depreciation and tax. New machine. New machine. I can see 5,400 throughout. I want an incremental, so less profit before depreciation of the old machine. So the old machine, what do we have there? I can see 3,200. We have 2,800. We have 3,000. We have, ladies and gentlemen, 2,400. And then lastly, we have 2,000. Thank you very much. Yeah, so give us the incremental profit before depreciation and what year? Tax. Profit before depreciation and the taxation. I hope you have your calculators. So the first one will be 5,400. 5,400 minus 3,200, which gives us 2,200. 22. So 5,400 minus 2,800, which gives me 2,600. From there we have 5,400 minus 3,000 which gives me 2,400. From there we have 5,400 minus 2,400, which gives me 3,000. So 5,400 minus 2,000, that gives me 3,400. Now, ladies and gentlemen, from there, what I expect you guys to do, because they have given me depreciation, they have given me tax, I expect you to compute depreciation for the two machines for us comfortably. So come and get some space there and calculate for us the depreciation for the two machines. That's as a separate working. My brother, look at this depreciation, new machine. Straight line, remember, depreciation, new machine. So the new machine from this particular paragraph, the paragraph that is talking about what here? New machine. They told us that the cost is 12,560 with a salvage value of 4,000, and then useful life is 5 years. So we have here 12,600, 12,560 minus 4,000 divided by how many years? 5 years. Divided by 5 years. Come here and they give us the depreciation of the old machine. Depreciation of the old machine as well. So the new machine, ladies and gentlemen, what do we have here for the new machine? This is quite easy. The new machine, we have 12,560 minus 4,000 equals divided by 5, which gives me 1712. Which gives me 1712. How about, ladies and gentlemen, the old machine? Kindly give me the answer for the depreciation of the old machine. Depreciation of the old machine. What do we have there? Depreciation of the old machine. I'm waiting. I'm giving you 2 minutes. I'm waiting for the answer. For the old machine. Mohammed, that's not right. Old machine, thank you for trying, but that's not right. Mohammed has corrected. We have 1300, HP saying 1850, Galaxy saying 13, Caro 1300. Let's see who is correct. Ladies and gentlemen, remember, the old machine was bought 2 years ago. Immediately after 2 years, we decided to revalue a machine. We decided to revalue the machine. When you revalue the machine, moving forward for purposes of depreciation, you should capture it at the net book value of that machine at the beginning of the next era now. So remember, 2 years ago, we were able to calculate its accumulated depreciation, and we even got its net book value. So the net book value after evaluation is what becomes your cost. Net book value after evaluation is what becomes your cost. Minus, they have told us, we have, ladies and gentlemen, 1,500 Kenya shillings as our scrap value moving forward. I'm not cooking my own things. We're reading, ladies and gentlemen, from note number, paragraph 1. Paragraph 1, you'll be able to see the second last sentence where they are talking over next 5 years with a salvage value of 1.5. So 1.5 is the same as 1500. And of course, what are the useful life moving forward? These are evaluation, These are evaluation. There's an evaluation here because you have changed the metrics. So you divide by what year? By 5 years. So let's see whether those students got it right. 4800 minus 1500. 4800 minus 1500 equals, divided by 5. We are supposed to get 660. 600. Thank you very much for trying, although you are wrong there. So come and less depreciation here. And please remember, this depreciation has to be incremental. The depreciation has to be incremental. So 1712 minus 660, like that. Remember, this is per annum, so every year. So we have 1712 minus answer, which gives me 1052. So we have 1052 throughout. So here we are, a subtract for us. What you will get will be called a profit before what? Before tax. What you will get will be called a profit before tax, you subtract. So we have 2200 minus answer, which gives us 1148. We have 2600 minus 1052, which gives us 1548. We have 2400 minus 1052, which gives us 1348. We have 3000 minus 1052, which gives us 1948. Then we have 3400 minus 1052, which gives us 2348, like that. Once you have your figures, these are profits before tax. Go ahead and share these to the taxman. So less tax at 30%. Tax 30% rate was given in note number, the last paragraph before required. 30%, yes. So 30%, we have times 0.3, the last one. I have the last one, 704.4. Then we have 1148 times 0.3, which gives us 344.4, 1548 times 0.3, which gives me 464.4, 1348 times 0.3, which gives me 404.4, and then we have 1948 times 0.3, 584.4. So you subtract. So we have here 1148 minus 344.4, which will give us 803.6. 1548 minus 464.4, which will give me 1083.6. 1348 minus 404.4, which will give me 943.6. Then we have 1948 minus 584.4, which will give me 1363.6. 2348 minus 704.4, which will give me 1643.6. So this represents to us the profits after what year? After taxation. Profits after tax, of which will come and add back depreciation. The last thing, you add back depreciation for you to be able to get what we call the cash flows. So our depreciation amounts already we have them, the incremental 1052, 1052, 1052, 1052, 1052, 10. I'm moving a little bit slow today because I know the sensitivity of this matter, right? Right. So we have there plus 1052. What figure am I able to get here? 26. 95.6. 1363.6 plus 1052. That gives me 24. 15.6. Then we have 943.6 plus 1052, giving me 19. 95.6. 1083.6 plus 1052. That gives me 21. 35.6. And then lastly, we have 803.6 plus 1052, which gives me 1855 point what here? 0.6, like that. Now, ladies and gentlemen, these are what we call the operational cash flows. These are which cash flows? Cash flows from our operations. These are our cash flows from our operations. So right there, operational cash flow. Once you have your operational cash flow, come and add the terminating cash flows. You add the terminal cash flows. The terminal cash flows, if my memory serves me well, you guys got 5,100, which was to come to us at the end of year 5. So at the end of year 5 here, come and add 5,100 like that. So we have here 26, 95.6 plus 5,100, which will give us 77, 95.6 like that. And then the others will remain, all the others will remain like that. All the other figures will remain like that. All the other figures will remain like that. Now, ladies and gentlemen, if that is the case, kindly come here and give us. Kindly come here and give us. Yes. How we got 1052? Yes. So we took, remember we calculated the depreciation of the new machine, 1712. And then we have depreciation of the old machine, 660. The difference between this and this is what gives us 1052, the difference. Brian Musioka had a network problem. So I hope, Brian, you are able to see how we got depreciations of the new machine and depreciation of the old machine. Right? Once we got those two parameters, we're able to subtract them. And now we came up with that figure. So come right away here. Now we want to do discounting. So you can mention there the discounting table. Discounting table, discounting table. How do you get the figure of 660? The figure of 660, we had our old machine. This old machine, we had stayed with it for 2 years. We had stayed with it for 2 years. Old machine, we had stayed with it for 2 years. For 2 years. For 2 years. And remember, for these 2 years, we were charging depreciation normally, and we were able to get a net book value, was it 1440, 4,800. We were able to get a net book value of 4,800 like that. Now, at the end of the second year, ladies and gentlemen, we called an expert. This expert came and revalued the machine and told us that, hey, you guys have got 5 more years. 5 more years. Remember, initially we had only left how many years? We'll be left with 3 years. Told us, no, you've got 5 more years. And then, unlike previously, you have a scrap value of 1,500. So then the question is, how do we get depreciation in between here? We'll take this net book value as the original cost for the period. So the original cost will be 4,800 minus now the scrap value of 1,500 divided by the 5 years, like that. If you do it that way, you'll be able to get 660. Just try and then you tell me. If you do it that way, you should be able to get the 660. Please, when getting this particular depletion per annum, whenever there is a revaluation, even in financial reporting, whenever there is a revaluation, there is no way you can make reference to the very old cost. No way. No way. No way. No way. So I hope Phoebe have answered you. Thank you. Great. Okay, so discounting schedule. Discounting schedule. So discounting schedule, quite easy. Now we have year 1, year 2, year 3, year 4, year 5. Ladies and gentlemen, we have our cash flows, which we'll need to discount. So cash flow for year 1 is 18, 55.6. Cash flow for year 2 is 21, 35.6. Year 3, we have 19, 95.62. 0.6. And then year 4, we have 2415.6. Year 5, you have to be careful, work with that total, 7795.6. So create a column for PV. What is the cost of capital? Cost of capital given is 13%. The cost of capital given is 13%. So please use this 13%, and then you give me the PVs for all the years, and then you give me the present value. You give me the total year. I'm giving you exactly 2 minutes. Brian, Paul, Sana, Brian, I told you if possible. Yeah, I can see someone advising you leave and enter again. Brian, and if possible, get Safaricom, the better option. So Alex is getting negative 509, 317. Mohammed is getting 104. Mohammed has not subtracted the initial outlay. After getting the total present value, Mohammed subtract the initial outlay to give us the net present value. Very good. From Mohammed is getting the same figure like our brother Alex got, and they are telling us to reject the replacement of the existing machine. Reject the replacement of the existing machine. So you see at 13%, what we have here. At 13%, ladies and gentlemen, this is what we have. At 13% in form of discounting. In form of discounting at 13%, we are talking of 1.13 because of the formula. The formula here, present value interest factor formula, PV formula is 1 plus R raised to negative n. So it will be 1.13 raised to negative 1, which gives us the first one, 0.8850. We go to the second one, so raised to power 2, which gives us 0.7831 raised to power 3, which gives us 0.6931 raised to power 4, which gives us 0.6133 raised to power 5, which gives us 0.5428. So now come and multiply this very fast. I have the first one, 1855.6 times 0.885, which gives us 1642.21. We have 2135.6 times 0.7831, which gives us 1672.39. Then we have 1995.6 times 0.6931, giving us 1383.15, 2415.6 times 0.6133, which will give me 1481.49. Then lastly, we have 7795.6 times 0.5428, giving us 4231.45. So come and add up everything. So we have here plus 1481.49 plus 1383.15 plus 1672.39 plus 1642.21, giving us 10410.69. This is our total present value. Once you have your total present value, what do? You'll come and less the initial outlay. Less the initial outlay. So the initial outlay, we had computed the initial outlay. We have the initial outlay. We had computed the initial outlay with yourselves and got 5,100. 5,000. Is that the case, really? We did the initial outlay with you and we got 5,000. No. I'm reading the wrong one. The initial outlay, we got quite a huge figure. It was 10,920. 10,920. 10,920. This was 10,920. 10,920. We subtract it. So we have here minus 10,920, which gives us minus 509.308 net present value. Meaning that this project is not viable. Don't replace. Do not replace. So now I want you guys to do me a favor. I would want us to do these two questions as assignments. If possible tonight. November 2017, question 4. November 2017, question 4. And then we have November 2016, question 4. November 2016, question 4. The moment we do those two questions, we shall be good to go. I know that today's lesson has been a bit tough on you, but I want to imagine that you guys have been able to pick a few things here and there. So you can start working on the homework questions right away and then you start posting the answers in our WhatsApp group. Otherwise, thank you very much. Let's meet in our next lesson. Unless there is a question, allow mwalimu to disappear. Which question? Yeah, the homework questions. We have November 2017 question 4C. That's number 1. November 2017 question 4C. And then we have November 2016, November 2016, November 2016, question number 4C. This is like a must-come question. It's a must-come question, must-come question. Otherwise, thank you very much. Good night. Brian, I'm sorry. I need to apologize to Brian. Welcome, Mohammed.